Economic policies in the United States play a crucial role in shaping the housing market. From interest rates to tax incentives, these policies directly influence home affordability, construction activity, and overall market dynamics. Understanding these policies helps stakeholders, from buyers and sellers to investors and developers, navigate the complexities of the housing landscape. Here are the top 10 economic policies in the U.S. and their effects on the housing market. 1. Monetary policy and interest rates. The Federal Reserve's monetary policy significantly impacts interest rates, which directly affect mortgage rates. When the Fed lowers interest rates, borrowing costs decrease, making homeownership more accessible. Conversely, rising interest rates can dampen demand for housing, as higher mortgage payments deter potential buyers and lead to a slowdown in the market. 2. Tax policy. Federal tax policies, including deductions for mortgage interest and property taxes, play a significant role in housing affordability. Changes in tax legislation can either incentivize or discourage homeownership. For example, the Tax Cuts and Jobs Act of 2017 limited the state and local tax, SALT, deduction, which could dissuade buyers in high tax areas from purchasing homes, impacting market dynamics. 3. Housing supply policies. Government policies that promote housing supply, such as zoning reforms and incentives for affordable housing development, can alleviate housing shortages. Policies encouraging mixed-use developments and the construction of affordable housing can help stabilize prices and increase access to homeownership, especially in urban areas where demand is high. 4. Down payment assistance programs. Federal and state down payment assistance programs help first-time homebuyers overcome the barrier of high upfront costs. By providing grants or low-interest loans for down payments, these programs can stimulate demand in the housing market, leading to increased sales and potentially driving up home prices in competitive markets. 5. Affordable housing initiatives. Policies aimed at increasing the availability of affordable housing, such as the Low-Income Housing Tax Credit, LIHTC, help subsidize the construction and rehabilitation of rental properties. These initiatives can stabilize rental markets and provide more options for low to moderate income families, reducing pressure on the overall housing market. 6. FHA loan programs. The Federal Housing Administration, FHA, provides mortgage insurance on loans made by approved lenders, enabling buyers with lower credit scores and smaller down payments to qualify for home loans. FHA programs help broaden access to home ownership, particularly among first-time buyers, and contribute to increased demand in the housing market. 7. Trade policies and tariffs. Trade policies, including tariffs on construction materials, can increase building costs and slow down housing development. For instance, tariffs on lumber have contributed to rising home prices and reduced affordability, impacting overall market dynamics. Policymakers must balance trade concerns with the need for affordable housing. 8. Infrastructure investment. Government investment in infrastructure, such as roads, public transportation, and utilities, can significantly influence housing markets. Improved infrastructure increases accessibility and desirability in certain areas, leading to higher property values and stimulating new development. Conversely, neglecting infrastructure can hinder growth and reduce housing demand in certain regions. 9. Regulations on home construction. Building regulations and permits can affect the speed and cost of housing development. Streamlined processes and reduced regulatory burdens can encourage more construction, while excessive regulations may slow down development and exacerbate housing shortages. Policymakers must strike a balance between ensuring safety and promoting growth. 10. Economic stimulus packages. Economic stimulus measures, such as those implemented during economic downturns or crises, can influence the housing market by boosting consumer confidence and spending. Programs that support job creation and income stability can lead to increased demand for housing, stimulating both the sales and rental markets. Economic policies in the U.S. have a profound impact on the housing market, influencing everything from affordability and supply to demand and investment. Understanding these policies is essential for anyone involved in the real estate market. As the housing landscape continues to evolve, policymakers must consider the broader implications of their decisions to foster a stable and sustainable housing market that meets the needs of all Americans.